Hello, this is Fred Jacobs. It's a pleasure. Thank you for joining our webinar on a very important topic, ILP. We normally when you do a webinar, you have about 100 people signed up. We have close to 300 signed up today. So this is obviously an exciting topic. If you're looking at launching a fund or have current funds in Europe, Ireland obviously is a highly traditional and strong location to do it for many reasons that will be discussed today. We have a phenomenal panel, and I'd like to go ahead and start introducing that. To begin with, I'm Fred Jacobs. I've been in the industry for quite some time. I'm on the advisory committee for Hazeltree, which is a phenomenal cash management tool. We would like to introduce, first of all, I'm going to start with Conor, Durkin, and Sara O'Reilly. Both are with the investment funds partners at one of the 5 largest law firms in Ireland, Mason, Hayes, and Curran. They both specialize in investment funds and asset management. And it's a full service business law firm that handles tier 1 clients, et cetera. So a great firm to have on this webinar. Then I'm joined by Paul Whelan. Paul and I have worked together many times, and Paul's head of depositary services at CSC, fund administrator and corporate service provider globally. He's responsible for driving strategy and business growth across Europe. And he's a seasoned leader who's gained a wealth of experience and technical experience in over 20 years in the fund industry, and would be an expert on custody and depositary and all things considered. Kevin and I have also worked together in the past. Kevin's a director at Keysight Fund Management. It's a Dublin-based AIFM, and Kevin is going to explain that for us. Founded in 2014, although Kevin has 28 years experience in the Irish funds industry and is certainly an expert on all things compliance, administrative, and depositary. Kevin is, Keysight is a third-party management company with specialization in real estate, real property, and private equity vehicles. So I'm going to start out with the first question for Conor. We have a lot of folks from both US and Europe and other people globally. So why is ILP all of a sudden so important for this global audience? Conor.
Thanks, Fred, and thanks for the introduction. So when US managers, or indeed global managers, are looking to raise capital in Europe, they're looking for a vehicle that ticks many boxes. So often US managers want a fund vehicle that is suitable for European institutional investors, that is tax transparent, and that can be distributed throughout the EU under the marketing passport that's available under AIFMD. The Investment Limited Partnership, or ILP for short, satisfies these requirements. The ILP is a regulated fund vehicle, and therefore it is suitable for capital raising from, for example, French or German institutional investors, who sometimes are required under their charter to allocate a minimum level of investments to a regulated vehicle. An ILP that appoints an authorized AIFM in the EU can utilize the marketing passport under AIFMD, and therefore it can be marketed to professional investors throughout the EU. Up to now, US and global managers have required a tax transparent vehicle that could be easily distributed in Europe, had no choice but to look to Luxembourg and set up a partnership vehicle there. The ILP offers a new vehicle which is an alternative. Therefore, when deciding where to establish a private fund for distribution in Europe, EU managers now have a greater choice, and they're able to determine the appropriate domicile based on the usual considerations of service standards, cost structure, regulatory approach, and ease of doing business.
Great, well, thank you very much. Let's look at a couple other things. And basically, who can be a general partner, a GP?
So the GP is the entity that is responsible for the management of the ILP. It manages that the ILP in accordance with the partnership agreement. The general partner will delegate day-to-day management of the partnership to an AIFM that retains responsibility for managing the assets of the ILP in accordance with the AIFM agreement. As regards the entities that are suitable to act as a GP, there's a very limited extent of regulation that applies to the general partner. The sole requirement is that the directors of the general partner be approved under the central bank's fitness and probity regime. Otherwise, the general partner is not required to be regulated, and it is not subject to capital requirements. The general partner could be an Irish company, or indeed it could be an overseas company. As a matter of Irish partnership law, the general partner would be liable for the debts of the partnership. However, as the general partner is typically a limited liability with a nominal amount of share capital, liability is ring-fenced to the general partner and would not extend to the owner or indeed the sponsor of the general partner.
Great. You mentioned fitness and probity. Can you mind just giving a quick definition there? And when we get to Kevin, I'll ask Kevin to give a definition of AIFM.
Very good. So when we are referring to fitness and probity, we're referring to the approval process that the central bank applies. Applicants for the position of director to a general partner are required to file an individual questionnaire with the central bank. And the assessment will be in respect of the director's experience and competence in managing collective investment vehicles and asset management generally. So that's what we mean by a fitness and probity assessment.
Okay, great. A couple of things. You all can ask questions. This obviously is live, and so we'll see your questions and I'll try to incorporate them. So please feel free to ask questions. Now, I'd like to move over to Sara O'Reilly. And Sara, obviously, Ireland seeks to improve upon everything that's been done in the past. And so what are some of the key enhancements that ILPs bring to the market?
Well, the new legislation came into force on the 1st of February. So it amended the previous 1994 Act, bringing in a couple of key enhancements that I'm just going to mention below that I think are important for the audience. The first one is that an ILP can now be established as an umbrella fund with segregated liability between sub-funds. And just to explain what segregated liability means, it means that the assets of one sub-fund can't be used to discharge the liabilities of another. So in other words, the assets are ring-fenced in each sub-fund. So the umbrella structure, I suppose, in terms of its advantages, it provides flexibility for managers to house different strategies or investor types in different sub-funds. You can also appoint a different investment manager to each of your sub-funds. It also means that the same service providers, for example, the AIFM, the Depositary, and the administrator can be retained for the umbrella, so can act as service providers to each of the sub-funds, which creates significant economies of scale. The other...
Okay, great. Thank you very much. And we're getting some good questions in. And from a tax perspective, what's the treatment of an ILP?
An ILP is tax transparent for Irish tax purposes. So it means that the income and gains accrue directly to each partner. So that's the way it's treated. So there's no tax leakage in using an ILP. The limited partners, of course, would be subject to tax in their country of residence and country where the investment is situated. But that's obviously subject to any relief available under applicable double taxation treaties. And I suppose an important point for this audience is that given the tax transparent nature of the partnership, it allows for US investors to check the box for US tax purposes.
Okay, great. No, it's kind of exciting how many questions we're getting. I think people are very, very interested in this topic. And we've had some questions here regarding this. Is the approval process for the central bank. Can we talk about that, and then we'll go back to something about Luxembourg. But what is the approval process, and specifically as well for the fitness and probity?
In terms of I'm going to talk about the approval process with the central bank, and firstly, so as opposed to the fund approval process, as opposed to the fitness and probity approval process. So I suppose we expect that most of the ILPs will be set up as QAIFs rather than RAIFs, which are qualified investor alternative investment funds. The QAIF isn't restricted in terms of the assets it can invest in, and it's not subject to any investment restrictions, whereas the RAIF is subject to more restrictions in terms of regulation. So importantly for QAIFs, there is a fast-track 24-hour approval process with the Central Bank of Ireland. So there's no pre-review of documents by the Central Bank. So once all of the documents are filed, so that would include the prospectus, the material agreements with the service providers, the various central bank application forms, and the confirmation letters that are required. So once they're filed by 3 p.m. the day prior to authorization, the central bank will authorize the partnership QAIF the following day.
Okay, well, that's great.
Just to note, Fred, that there is a pre-submission requirement for certain vehicles. For example, real estate, loan origination, life settlement, and more highly leveraged vehicles.
Okay, great. So it pays to get a good law firm to help you through this process, obviously. Yeah. And tell me, how would you compare Ireland to Luxembourg? So I think people are probably familiar with Luxembourg and less familiar. So how would you, with Ireland, how would you compare the two?
I suppose with the new regime in Ireland, there's a level playing field now in terms of structuring between Ireland and Luxembourg. So managers have a choice in terms of which jurisdiction to go with. However, Ireland has a number of additional benefits. As a result of Brexit, it's now the only English-speaking member of the EU. Ireland has a common law system, which US and UK managers are more familiar with, whereas Luxembourg has a civil law system. And Ireland, as many of you know, and is a centre of, for the last over 30 years, is a centre of excellence for investment funds with $3.8 trillion domiciled here. And it's known for its excellent servicing capabilities with all of the big service providers, investment managers with a presence here.
Great. Well, thank you very much, Sara. And so let's move on to Paul Whelan. And Paul, depositary is something we hear, and oftentimes people equate it to depository. So can you please give us a definition of depositary so that we know we're on a level playing field here?
Yeah, sure, Fred. First of all, I think it's important to recognise that the depository is not a delegate of the GP or the AIFM. It's an independent service provider and has a fiduciary responsibility to act in the interest of the limited partners. The depository must be domiciled in Ireland and be authorised by the central bank as a full scope or specialised real asset depository. Under AIFMD, the Alternative Investment Fund Managers Directive, the depository is obliged to discharge three main duties: cash flow monitoring, asset safekeeping, and oversight. Cash flow monitoring involves reviewing all cash flows through an ILP's bank accounts with an aim of identifying any significant cash flows and cash flows that are inconsistent with the operations of the ILP. The depository has to ensure that bank accounts are opened with appropriate institutions in the name of the ILP and that all capital contributions are paid into the operational bank account of the ILP. Moving on to asset safekeeping, which covers both assets in custody and record keeping and ownership verification of other assets, i.e. non-custodizable assets. I'll probably skip over assets, safekeeping of assets in custody because it's not hugely relevant to ILP structures. However, record keeping and ownership verification of other assets involves ensuring that all non-custody assets, such as private equity, real estate, infrastructure investments, are held in the ownership of the ILP, both initially at the point of the transaction and on an ongoing basis. And the depository is required to keep an up-to-date register of all other assets that it's satisfied are owned by the ILP. And the final duty then is that of oversight. And this duty is quite broad. It involves overseeing the AIFM and its delegates to ensure that the ILP is managed in accordance with its constitutional documents and the regulations. And the depository would generally focus its reviews on the valuation of assets, capital activity, income distributions, investment restriction, monitoring waterfall calculations and settlement of investment transactions. And then the depository would be required to report any material issues, NAV errors, or investment breaches to the Central Bank of Ireland.
Okay, great. Thank you very much. And how does the ILP impact the depository landscape in Ireland? You kind of touched on that some.
Yeah. I think, depository services has traditionally been the domain of large custody bank entities, and I think the introduction of the ILP will be a catalyst for the entry of a number of new non-bank depositories to the market. These depositories will be authorized as a depository of assets other than financial instruments, which is a bit of a mouthful. But these specialized depositories will be authorized to act for closed-ended ILPs without redemption rights for 5 years that generally do not invest in financial assets. Now, the authorization process for these depositories will take 3 to 6 months, maybe even longer, and I think that's indicative of the gravity that the central bank places on the depository function. But certainly these new entrants will provide a lot of choice to general partners who may appreciate a more flexible and bespoke service than the traditional custody banks can offer. And I think will certainly benefit the small to medium-sized managers who can feel neglected and underserved by larger bank providers.
Great. So one question was about, is this being recorded? It will be, and it will be on the websites of the participants. So CSC provides depositary, but how can a manager differentiate? There's many people that provide it. What makes a good depositary?
Yeah, I think there's a number of elements, but I think first of all, the depository should be able to understand and speak to the asset class, the fund structure, the transaction life cycle, and understand the associated risks with that. And then they should be able to build a flexible depository solution that fits seamlessly with the GP and the AIFM's existing operating model and infrastructure, and also provide clarity on what information and data is expected from the GP, the AIFM, and its delegates. And a model that's not overly intrusive, but allows the depository to discharge its regulatory duties. And then I think a good depository will be transparent and provide regular reporting to the AIFM and to the board of the ILP. And this reporting should provide an overview of tasks that they've completed, frequency of those tasks, and then the results thereof. And then I think caliber, I think it's important that the depository is invested in high quality people and has implemented the technology, to schedule and track completion of activities, and doesn't see the depository as just a bolt on to their corporate or fund admin services with little thought given to it. And I suspect this will be the case with some providers.
Certainly, and not all administrators offer as well. So, I'd like to move over to Kevin O'Doherty. And Kevin, once you're online here, can you tell us, we've heard AIFM. Can you give us a good definition here of what an AIFM is?
Yeah, and I'm sorry to non-EU viewers, there's an awful lot of jargon in this area. Asset management in the European Union is divided into two types. There's retail, akin to a 40 Act fund, and non-retail. So anything that's non-retail is called an alternative investment fund, AIF. They're required to have a manager called AIFM. The way that they wrote the rules is they wrote rules for the manager, not for the fund, which are then imposed down on the fund. So that's why you see this term AIFM popping up from time to time. It just means the fund manager. It's the person who's legally responsible for managing its regulated activity in the European Union. And so if you have, say, for example, a US sponsor looking to put together an ILP with a number of investors in different jurisdictions, and let's say, a US or a Cayman or a BVI GP company, the AIFM is the bit you need to tack on to be compliant with the European legislation. As Conor said at the beginning, they're a delegate of the GP. They can be fired by the GP, but legally they're the ones who have responsibility for doing the management. That's risk management, portfolio management, administration, marketing. There's a list in the back of the legislation of what constitutes being an AIF manager.
Okay, great. And what are the benefits of using a hosted AIFM for regulatory compliance and EU expertise?
Yeah, so if you're going to have a European AIF, you need a European AIFM, and you can either grow one yourself or you can use what's called a hosted AIFM, which is a firm like Keysight. We have the regulatory approvals. We don't conduct our own proprietary private wealth business or anything like that. What we do is we work with outside fund promoters to attain their regulated status without themselves having to go through the regulatory process. We do the heavy lifting on the regulatory side. The benefit of, why do I want an AIFM at all? In Europe, sorry, it's the law. You got to have one of these things.
So you couldn't do this yourself. You've got to hire
there has to
someone
be
like yourself.
There has to be an AIFM, and again, if you're big and ugly enough as a financial services group, you'll probably go out and form your own one. This is a quick route to market, and you get the benefit of a local jungle guide for hire who can take you through the various sand traps and stuff like that that exist in any regulated environment. Why do you want an AIF at all as opposed to just doing a Cayman LP? The answer is to get into Europe. The great thing about the ILP is that it's a regulated fund vehicle, just like a hedge fund, and it benefits from the pan-European passport that's set out in the AIFM directive. So as long as your investors are not members of the retail public, they're professional investors, you can passport your Irish ILP into any other EU member state. It's just a simple registration process. Not particularly different, say, US blue sky filings and things like that. It takes a lot of the regulatory heartache out of going to each single jurisdiction on their national private placement regimes. You just cruise straight in the front door.
I can imagine that going to each individual one, they all have different laws and timing and et cetera, and costs.
Yeah.
What's that?
And different languages.
In different languages. Yeah. So that's also an issue. Okay, great. Well, this, we're right on time. This basically ends the main section of what we wanted to cover, but I did want to go back to each of the panelists, asking the same question to each. What's one point you'd like people to take away from the conversation? So if the people on board here only heard one thing, what would be the main thing? And why don't we start with Conor?
Thanks, Fred. For me, it's that Ireland is a viable and credible jurisdiction in which to establish a private fund, particularly for distribution into the EU. And if a manager is considering or looking to determine where to domicile a fund vehicle for that purpose, Ireland now needs to be a part of that analysis. That's a key takeaway from my perspective.
So when you say viable jurisdiction, can you pull that, what does that mean? I mean, can you pull that out a little bit more?
I'm referring to various factors in relation to that. I'm talking about the vehicle itself being attractive from a tax perspective because it's tax transparent. That's one aspect of it. I'm talking about servicing capabilities in Ireland as well. There's a tremendous depth of talent in Ireland for servicing of real assets, and we're acknowledged as a centre of excellence. I'm talking about the cost structure as well. If you're looking at analysing fund vehicles, you'll have to bear in mind the cost. And again, we think that Ireland compares favourably internationally in that respect as well. So when you pull those various factors together, it's leading to an offering that's very attractive.
Certainly, and Sara covered on some of those things earlier. Sara, why don't we go to you? What's the one thing that you think you wanted to highlight?
Well, I suppose the new partnership regime means that Ireland is, on an equal footing with other jurisdictions, which is great news for Ireland. It also makes Ireland a domicile of choice for US and UK managers seeking to establish private equity, real estate, infrastructure, and I suppose the new kid on the block, sustainable investment funds. So I think it does give a lot more choice
Okay, great. Paul?
Yeah, I think the one thing that I'd like people to take away is that Ireland's open for business for real asset managers. We have the right product now to meet the needs of these managers. I think it puts Ireland in pole position to capitalise on its well acknowledged service levels and depths of service provider expertise to become, as Sara said, the domicile of choice in Europe for real asset managers.
Okay, great. And Mr. O'Doherty.
Well, there's two things I'd point out. One is, again, just echoing the other guys, we think Ireland's a great place to do business like this, particularly for US managers. We've been a bridgehead into the European Union for 30 years in the hedge fund, alternative fund area. Ireland is well known for doing fund-like stuff like asset financing, aircraft leasing and things like that. So we're well accustomed to this sort of business. We've got a great infrastructure of lawyers and accountants in a place. Our tax laws are very clear. Our contract law is very clear. It's a great place to do this sort of business. The other point I'd make is in relation to the ILP itself. You can do lots of really cool stuff with it. So, for example, you don't have to issue partnership interests at NAV. So if you want to do funding rounds, you can do them at set price. You can do them with an inflator. It can be predetermined. The issue is, all you need to do is make sure that's set out in the ILP in advance. You don't spring surprises on people. Similarly, as Sara said, you can have people can be excused from participation in certain investments. Now, that is, or indeed forcibly excluded. Now, that is designed to protect the tax status of things, but it's actually the way it's written. You could actually have a great degree of latitude in how you differentiate between the classes of the partners. The vehicle, again, it was designed with a funds philosophy in mind, so it's an umbrella vehicle. So you can actually run multiple LPs within the same structure using a single GP entity. So it cuts down on your administrative costs and the like. There's full capacity to handle co-invest and carried interest. You could even run them inside the umbrella GP if you wanted to, or as Conor said, they could be separate entities which are tax domiciled in another jurisdiction. It's great. It's like a piece of Lego. You can just add bits and take bits away from it as you need to. It's a wonderful piece of kit.
Great, thank you. There were some questions that, now, before we go on, are there any comments that the panelists have now heard because they've heard everyone else? Is there anything I missed asking you that you would like to address at this point? Everybody's happy? Okay. So there were several questions, and one of them was answered, but I would like everyone to hear the answer. Kevin, you answered, what are the disclosure requirements of an ILP? And is it required to file accounts which then are publicly available? So why don't you take that, Kevin, and anyone else? So how public are these accounts, et cetera? Who sees them?
Yeah, well, let's take a broader thing. What do people get to know about your partnership? Obviously, the investors coming in, there's going to be an LPA. There may be some sort of document that sets out what they're actually buying into. But as you've seen in the States with SPACs, that's a movable feast. With regard to accounts, there's no such discretion. It is a set of audited accounts that need to be prepared every year. Now, they don't go anywhere. They go to the partners, and they're filed with the central bank as part of their supervisory regime, but they are not publicly available. So the partners get a proper accounting, everyone can see what's going on, but it doesn't end up in the newspapers.
Okay, so there are a few questions on tax related. So does and I'm not sure if we have, if you guys would like to answer these, but does the ILP make an Irish tax return? And if so, is it public, or do investors need to make any returns? How does the whole tax return process work?
Maybe I can handle that. It's a tax transparent vehicle, so it's not taxed in and of itself. It's the individual partners that pay tax.
Okay.
And just on that, developing out what Kevin has said, I think there was a question also relating to the tax treatment of funds that might hold Irish real estate. That is subject to
I was getting to that. Yeah, that was
sorry.
a good question. No, go for it. Yeah, I was going to ask you the question anyway. So
that's really vehicle neutral. So to the extent that you have a vehicle, whether it be an ICAV or an Irish partnership that happens to invest into Irish real estate, then the Irish tax code applies. And if you have more than 20% of the portfolio constituting Irish real estate, then you're involved in the IREF tax regime, and therefore have to make filings and pay tax in respect of gains and incomes within the portfolio of Irish real estate. But that wouldn't be the typical structure, in the sense that investment limited partnerships could hold assets globally. So that wouldn't apply. The normal tax treatment wouldn't apply if you were holding assets other than Irish real estate, is the point.
Yeah, that regime is primarily designed to stop, rich Irish people putting their own personal real estate investments into a fund vehicle to avoid tax.
Okay, yeah. I'll leave that one alone. So we've talked about the benefits for US and Europe, etc. Can we cover the Asian markets, Singapore, Hong Kong, etc.? What benefits could apply for them?
From my perspective, again, the benefit of the partnership vehicle is a gateway into Europe. It is the vehicle that allows a Hong Kong manager, for example, to distribute with relative ease in the European Union. In addition to that, when you compare, let's say, the Irish vehicle against other vehicles, the partnership vehicle itself is regulated, and that offers further distribution advantages. Because if you look at some of the professional or institutional investors in Europe, they may be restrained by the extent to which they can invest, and some of them are mandated under the terms of their own constitution, and therefore are required to allocate to regulated vehicles, which the ILP will be, because it'll be authorised, as Sara said, either as a RAIF or as a QAIF.
Okay. So another general question here. If I'm a US manager, do I have the authority or discretion to manage the portfolio of investments?
Sorry, go ahead, Conor.
Go ahead, Kevin. You take that. You're the AIFM. Let's hear about the AIFM's perspective on that.
I'm going to take advantage of something Conor can say, is to say I'm not giving legal advice. The point is, within the ILP itself, the ILP is regulated, the Depositary is regulated, the AIFM is regulated, the GP, none of the other parties are required to be regulated. If somebody's providing services to the ILP, they need to make sure that they have whatever regulatory requirements that are imposed on them in their jurisdiction. So if you are, say, for example, a UK manager providing very clear and explicit investment management in financial instruments services into the ILP, that draws you within the scope of a European piece of legislation called MiFID. If you're advising on real estate, there's no regulation. It depends on who you are, what you're doing, and in what you're managing.
Okay, we had a lot of questions about timing, and I know we had a question on the fitness and probity, how long that takes, but just in general, will the central bank approval process cause any delays once they get to that step?
As I said earlier, the central bank approval process is 24 hours, so it's a fast track approval process. So the central bank won't delay the approval process, but obviously prior to getting to that stage, you need to take into account the fact that the prospectus has to be probably go through a couple of rounds of comments with everybody. The service providers agreements need to be negotiated and agreed. Also, the fitness and probity regime needs to be gone through for the directors. And so taking all that into account, you need to allow about 8 to 12 weeks to be at the stage where you're there with final documents to file with the central bank. But the central bank itself won't delay the process. It's 24 hours.
24 hours, yeah. That's great. There's a question
Fred,
that
just on that, I think
certainly.
if we're comparing with other jurisdictions, it certainly compares very favorably with other jurisdictions in terms of speed to market. So that shouldn't be a concern for managers establishing funds in Ireland.
Which is interesting that you're saying that, because the questions come up, something that was covered, but I think we should hit it again. Does the ILP structure give any competitive advantage to Ireland over Luxembourg for partnership vehicles? So I know, Sara, you hit on some of that. Are there other things that you'd like to say, or anybody else like to comment there as well?
Yeah, Fred, it just really comes down to sort of cultural differences. There's a lot of stuff in Luxembourg might be as clear cut as the regulation in Ireland, might be sort of more negotiated. You tend to know off the bat in Ireland whether you can do something or not. The other thing is, we're used to working in English, we're used to working with American managers. Cultural differences.
Cultural differences, English speaking.
We think Anglo-Saxon. We're well used to dealing in the alternative sphere. We're well used to things like, Delaware and Cayman LPs, real estate, VC, PE funds, stuff like that.
There's also, I mean, you just look at flights, direct flights. Ireland has how many direct flights to the United States? So communication, I think, is when flights happen again.
Yeah, we also have an unusually large number of golf courses, but I didn't really want to throw that in there.
Okay, all right.
Fred, from my perspective on that, and when you're looking at it, you can look at it at a very, let's say, micro level, and there will be variations. There'll be variation in relation to the service standards. Both jurisdictions are excellent, are centres of excellence. There'll be a variation in relation to the cost structure as well. And indeed, touching on what Paul has mentioned at the introduction of a specialised depository in Ireland is to be welcomed, because that will round out and help develop Ireland's offering as a whole in respect of real assets. When you also look at, I suppose, the difference between a Luxembourg SCSP and its equivalent, the ILP, there may be a marginal advantage in relation to the fact that the vehicle is regulated itself. The tax code between both jurisdictions, again, maybe there's very little to be said, but one of the points there is to say that Ireland doesn't have a subscription tax that may or may not be applicable in Luxembourg, or at least you'll need to identify an exemption from that under the Luxembourg code. So when you take all of those cumulative factors together, you're looking at something different. And then just circling back to what Kevin has said, we're talking a lot about culture and standards and ease of doing business, and hopefully questions of less friction being involved in the product as well.
Okay, great. I have one more question, so if the audience has any other questions, again, this is taped, you can get all of this, but if you have a general partner and also an AIFM, who's really running the limited partnership?
Maybe I might take that one. As I said earlier, the AIFM is charged with doing a lot of stuff, but they're a delegate of the GP. They can be fired by the GP. So we bear a lot of legal responsibility for stuff. In reality, what we do is we collaborate very closely with the GP. Think of us as a jungle guide. We won't stop you from doing what you want to do, but we may stop you from doing stuff that you will later regret.
Okay, anybody else? All right, we did get a couple questions under the wire here. Will the LP make investments directly, or do you anticipate there'll be an investment holding platform underneath?
Yeah, I think, Fred, will be a combination. There's certainly the flexibility in the ILP for the partnerships to invest through either directly or through special purpose vehicles or S110s. So that flexibility is there. It's really at the manager's discretion as to how he wants to structure the transactions.
Oh yes, please.
No, I'm really echoing what Paul is saying there. There may be a tax advantage to incorporating a blocker. That could be a Section 110 vehicle, which might have a tax advantage. Indeed, it could be a private limited company in any jurisdiction potentially, or indeed it could be a partnership vehicle itself, which might be used purely as a nominee and simply for ease of holding the assets itself. And indeed it could be a corporate structure which effectively strips out and doesn't cause any tax disadvantage because it's used barely or purely as a nominee. So lots of structuring options there in respect of it. But I guess maybe to round out that answer, yes, there a lot of assets will have a holding structure, and it will be the ILP that will hold an investment in the holding structure that holds the asset.
Okay, good. There's one last question before I say it. I want to thank Michael, Kraken, and some of the others. These have been some great questions. We really appreciate them. Is taxation a benefit of the Irish LP over Luxembourg?
I would say that, again, partnerships are tax neutral. That's how they should operate. So at a global level, both should be tax neutral and shouldn't cause a tax disadvantage. Where there might be a differential in approach might possibly be in relation to the tax structuring, and therefore you're looking at potentially using intermediate vehicles, whether in Ireland or Luxembourg, and that might give an advantage one way or the other. One overarching comment I would make in that respect is that for collective investment vehicles, generally, we don't in Ireland apply what Luxembourg would apply to a number of different types of fund vehicles as a subscription tax. So the question at a higher level might be whether or not the Luxembourg vehicle will be subject to that. But in fairness, there are fairly generous exemptions to that within the context of private funds as well in Luxembourg. So broadly neutral enough between both jurisdictions.
Okay, great. Kevin, can you give us a definition of a Section 110 company?
Yeah, and again, apologies to people not familiar with the Irish regime listening in. We have a lot of terminology for this stuff. Section 110 is a reference to the Irish tax code, and it's, as Conor said, it's an intermediate blocker company. It's a conduit vehicle. It doesn't pay any Irish tax. Basically speaking, it's a way that you get stuff in, like, say, for example, aircraft lease payments or credit card receivables, and you pay out to effectively note holders or bond holders. The vehicle generally doesn't pay Irish tax. It doesn't make a profit. It is only a very small amount of capital. The whole idea is over the life of the vehicle, it makes enough profit to pay for its own winding up at the end of the day. But other than that, it's just a straight pass-through vehicle.
Great, thank you. That pretty much ends our time. So I really want to say thank you to Kevin, to Paul, to Sara, to Conor. Highly informative in a very short amount of time. I think this will be good for something people to re-listen or to pass to their friends who want to learn more. So I'd like to thank everyone for coming. Specifically the people who asked all the great questions, and have a good rest of your day. Thank you very much.